Good morning, folks. Thanks so much for joining us today. We are here from the economics department at Sonoma State University, and we are going to talk today about some of the things we've been seeing in the banking market and really more in the macroeconomy more generally. And I'm here joined today with Puspa Amri from our economics department, and my name is Rob Eyler. I'm a professor of economics at Sonoma State. And so what we're going to do is we're going to do just a simple moderation with Puspa here as our expert on what's going on in banking and more generally in the macroeconomy. And we're going to talk about some topics that are specific to Silicon Valley Bank, but also thinking about whether or not these problems are going to generalize and things we should also be thinking about here in the North Bay. Puspa, welcome and thank you for making the time today.
Thank you, Rob, for having me. Thank you, everyone. Welcome.
So explain to us sort of the key three items that you think led to what happened with SBE in the end of the day.
Sure, Rob. Thanks. So I see it as three factors. I'll list them first, and then I'll go into more detail explaining them. One, Silicon Valley Bank built up a fragile balance sheet that grew very quickly in just 3 years. And it seems evidence suggests that it was not that best managed in terms of risk management. Factor number two, there was a sharp increase in the monetary policy tightening environment. Interest rate rose very quickly, more than 400 basis points in just 1 year. And that hit Silicon Valley Bank on both the asset side and the liability side. Third, somehow there was a failure or sort of a shortcoming in terms of the supervisory and regulatory environment to act on risk features that were building up. Signs and reporting seems to suggest those issues were identified, but how quick that link was between identification of the problem and actual enforcement to correct the problem was still lacking in our understanding.
Totally. Thank you for bringing out those main three items. And I think it's important to also say that Puspa and I are the two people at Sonoma State over the last 7 or 8 years that teach our money and banking course. So she and I kind of watch these issues all the time. And one of the biggest things I've been thinking about since we saw this news and kind of better understood those three factors that kind of all came together as one to really shake up Silicon Valley Bank and also some other issues with crypto that we saw in a couple other banks, Signature Bank being one of them, is
correct.
How important is what's happened with SVB in terms of lending markets at the macro level or even more broadly financial markets?
Sure. Thanks for that, Rob. So one of the things about banks is that they are actually fragile by design. And of course, in our money and banking classes, we teach this. These are institutions that take deposits, which are very short-term in nature, and then turn them into loans that are long-term in nature. They do so for a profit, of course, but they also serve society as an important role to intermediate the needs of the borrowers and the savers. However, due to that differences in maturity of their liability side and their asset side, there is, of course, the situation where there's a mismatch of liabilities and assets. Their liabilities are short-term, their assets are long-term. So if there's ever any doubt about the solvency of this bank's balance sheet, if there's enough of a critical mass that starts to doubt the value of their balance sheet, they might rush to pull their deposit out and liquidate it. And no bank is going to have at one point in time enough ability to turn their assets into liquid liabilities to meet their depositors' rush. And so therefore, the way I see this problem being connected to the financial world in general is that the moment there were massive orders of withdrawals being put at Silicon Valley Bank, investors started to immediately look at other banks that had a similar risk profile and doing one of the same things that the Silicon Valley Bank was doing, which is this is something that a lot of banks had been doing over the last 1.5 years to 3 years, which is they've invested a lot of their asset sides into long-term government bonds and government-backed mortgage securities that are backed by government agencies. Mm-hmm. In a normal environment, this won't be much of a problem, but as we've already just discussed, the monetary tightening of the Federal Reserve had an impact on lowering the value of those assets. And so there was, at the same week that we saw Silicon Valley Bank having problems, similar banks were also getting hit by their own depositors, and also the shares of those banks were also falling.
So with that, as to just play right off of that, one of the other things that I keep thinking about is now that First Citizens has purchased Silicon Valley Bank and perhaps infused enough capital to kind of keep the riskiness that SVB brought to First Citizens somewhat mitigated. Are we out of the woods yet? And if we're not, why not?
Broadly speaking, defining we out of the woods yet depends on for whom, in my opinion, and it depends on also what are our objectives. One thing that I did note is that the portfolio of the securities, the ones that had fallen in value, the ones that were sort of the trigger of the initial problems, those are actually still being liquidated by the FDIC. So from my understanding, First Citizens is taking over a lot of Silicon Valley Bank's loan portfolios, but the FDIC is still primarily in charge of selling those mortgage-backed securities, those long-term mortgage-backed securities, whose, of course, value tends to fall more the longer the duration of the assets itself. And so I see it more of a glass half full, glass half empty. You could be optimistic about it, you could be pessimistic about it. On the one side, the fact that a lot of these government securities are still being handled by FDIC sort of, I think, relieves First Citizens on these particular possibilities. Of course, in actual practice, an liquidation or a transition of ownership of any financial institution, any institution for that matter, is never easy. So I think there may be perhaps still some issues to work out logistically about certain billions of loans that are that people who borrow money from the SVB and corporations, as well as small businesses, perhaps smaller firms that currently have loans with Silicon Valley Bank. Will they now be servicing their debt to First Citizens, and how will that work, et cetera, et cetera. But I think First Citizens is actually quite excited to venture into a new area of lending portfolio and clients to service. That's something that was it's not unlucrative to my understanding, but they're excited to add that to their portfolio from my impression that I got.
Yeah, and one of the things in banking history is that when you see problems like this, one has to remember that while the FDIC and our sort of broader government regulatory structure around banking is going to try to facilitate a transaction rather than actually pay out of the insurance fund, you have to find another institution who's willing to take on that risk blow. And in certain cases in banking history, we've seen where banks have run away from that because the risk is so systemic, and in some cases it's so hidden in the balance sheets of the acquired bank, it's tough to figure out. Folks, real quick, before we go on to the next question for Puspa, what I wanted to do is I want to remind you, or I should have said this right off the top, I apologize, is that please use the chat function here in Zoom to ask any questions you have of Puspa, and we'll read those after I get through a couple other questions just to kind of tee up the general idea of what we're trying to provide for you guys today is an overview from sort of an industry and macro viewpoint of what's happened over the last few weeks. So Puspa, the next question I was going to ask you is kind of going back to the Federal Reserve. I wanted to ask is, if the Federal Reserve continues to increase interest rates and the inflation data suggests that there's going to be some more pressure on the FOMC to continue to think very deeply about whether or not we need rates to kick maybe another 50, maybe another 75 basis points. They've gone all over the place about where they see it. And then, of course, the rhetoric somewhat changed over the last 2 months because of what's happened in banking. Does another increase, let's say just for the sake of argument, let's say 50 basis points over the next quarter, not in the quarter we're currently in, quarter two, how much more risk can that impute into the banking industry? Is that something we should be worried about?
Thanks, Rob, for those questions. I think there are, again, reasons to be optimistic and reasons to be pessimistic. On the one hand, I think for sure the interest rate risk for all banks are still present. I think a recent paper published at the National Bureau of Economic Research points to the fact that currently all commercial banks altogether face the potential of unrealized losses on their balance sheet for the assets that are long-term due to the rise in interest rate. There's about a 10% lower value on the government securities as well as long-term bonds that they're holding. So that risk is, of course, present. However, I think also banking system is reacting to this event in a way that's predictable based on past events of banking crisis or financial instability episodes, which is they are doing an internal tightening of their own credit conditions. And that would probably means they are going to tighten up their, first of all, more due diligence on evaluating the value of their loan portfolio and the health of the banks, and maybe even increase the proportion of their assets that are held as cash. I see this as a really important issue because recent reports suggest that a lot of regional banks, or a lot of banks in the United States, particularly regional banks, have had a problem of a lower ratio of percentage of cash held as total assets. I think the latest article that I have is that Silicon Valley Bank, when before it collapsed, had 6% of its assets held in cash. Those are the numbers that I was managing to look up. So therefore, I expect a change in that direction. However, that same paper that I just referred to earlier, published at the National Bureau of Economic Research, also stated that while asset side problems, which is unrealized losses, as long as those are not sold, I don't think that would be posing such a huge problem. But on the liability side, there is still a very, very large problem of several banks having uninsured deposits to total deposits ratio to the tune that was unhealthy. I think I've said several experts have repeated this in their calculations. Silicon Valley Bank had about 92 to 93% of their deposits in the limit that is above the 250,000 coverage ratio. So that might be a problem. I think overall, it just points to the fact that the Federal Reserve is an institution that has any policy institution has limited tools to achieve multiple objectives. The primary objective of the Federal Reserve is the dual mandate, price stability alongside maximum employment. But managing financial stability is also part of their mandate too. And so that can be both achieved when you're having such a high inflationary environment such as this.
Yeah,
And
that lender. Yeah. I'm sorry, go ahead.
Well, yeah, Rob, I was actually going to ask you if you could also share some of your experience and analysis on what happened the last time the Federal Reserve raised interest rates so far there in the 80s. And that also had a little bit of a toll on the savings and loan industry in the US, correct?
Yeah, it did. And so if you look at banking history, one of the weird things about the early 1980s is that that's the last time we've seen Federal Reserve or the federal funds rate rise with this kind of velocity. The trickiness about that is we were coming out of kind of, let's say, two phases of inflation and a double dip recession that happened in the late 1970s and early 1980s. And you can say part of that was the spark of the inflation through energy prices. The others, we went through this weird monetary experiment in the end of the 1970s that had to get relieved through relatively fast contraction of interest rates because it caused a lot of inflation. But as we descended into the 80s, the thing that really took place was that as energy prices contracted, you saw real estate loans that started to go bad because they were a bet on energy prices remaining high and being able to pay relatively high interest rates. And we also saw sovereign lending fail, and we saw a lot of countries basically walk away and default on their debt. And all that happening simultaneously really changed the risk characteristics of banks, not necessarily because of what happened with the interest rates rising in the early 1980s, though one could make a case that the increase in interest rates attracted a lot of banks toward risk-taking that they thought, in fact, were being subsidized either by a sovereign government, real estate that was never lose its value based on the natural resources underneath. And when they both dove down simultaneously, we had kind of a similar situation in terms of depositors walking away from these banks and really investors becoming very nervous about continuing to infuse capital into those banks. So there are some parallels to, let's say, the early 1980s and the long descent we took into the early 1990s with bank failures. The beauty, at least at this case, and that's why I asked you the question before, because I agree, I don't think the problem is systemic for now, but there's got to be some other banks and lenders out there otherwise that have some risk exposure to the rise in interest rates. And so it makes you kind of wonder whether or not this one's going to be more policy created than risk taking created. Because that's another little characteristic I think I've seen about Silicon Valley Bank is it wasn't like they took a major credit risk. What they had was interest rate risk.
Exactly. See, that's the thing, Rob. The fragility that was the cause of past crisis don't always appear in the next new crisis. Yep. The last recent memory that we had was 2008, 2009. And there, the biggest culprit in terms of risk was credit risk. Financial institutions had a lot of assets that were very risky and could go sour really bad. And in this situation, I think that risk was quite minimal. Another thing was that a financial reporter used to say in the Financial Times, Gillian Tett used to say that we're still fighting scars from the last battle, something to that effect. And in the 2008-2009, regulators were really concerned about like checking whether or not the source on the liability side for the banks where they were funded by short-term funding, very short-term funding in the repo market, rather than deposits that were a little bit more longer term. But as it turns out, risk can appear in other places too. I mean, I think one of the Daniel Tarullo, who used to be the Federal Reserve Board of Governors for Supervision, always says that rapid growth of anything is always a source of concern for regulators. And Silicon Valley Bank tripled its deposit in just 3 years, making it therefore a category of a bank that should have been subject to more tighter regulation. And so perhaps there was a little bit of a lag in terms of the stepping up of which kinds of regulatory measures that Silicon Valley should have been subjected to in that response.
Yeah, and in fact, it seems like that banks and credit unions and savings banks are kind of all moving into three major categories. Ones that have a relatively large amount of checking penetration where most of their deposits were non-interest bearing and they were able to basically preserve liquidity as a result of that. A second group of banks that had a different mix where it's a little bit more interest rate risk exposure and they're creeping toward the point at which they're starting to run out of deposits vis-a-vis the amount of cash they have available for lending otherwise and don't have already committed to lending. And then a smaller group that's sort of the SBB light group that remains, which is in this weird interest rate risk category where they're really going to struggle to come out of it in terms of liquidity. Now, before we go on to the sort of final round of questions from me, what I want to do is I want to take some questions from folks that have asked here in our Q&A and on the and in the chat. So the first question was, you had said earlier, is fragile banking or booking another way of saying cooking the books? And I think you actually said fragile banking, not booking, correct?
Yes, that's fragile banking, not cooking. Correct.
Yeah, so we should not be thinking that the banks themselves were actually doing some weird accounting that may have created the issue where Silicon Valley Bank, I'm sorry, is now the poster child of that change.
That's correct. In fact, what they were doing is a strategy that in a very in a long secular period of low interest rate environment was not risky at all. More than half of their assets were actually in government securities or mortgage-backed securities that were backed by government agencies. These are relatively low risk, low credit risk, if you will, and therefore also a lot less capital had to be set aside for these. So yes, thank you for the opportunity for me to clarify that. It was fragile banking. And I think the fragility of their balance sheet that I looked at was that the deposits there was too high of a deposit that was in the amount of more than 90% of more than the $250,000 coverage limit. And in addition, there was also the fact that this is something we hadn't discussed yet, but I gave a lot of thought about to Rob, if you don't mind, maybe just use this opportunity to mention this. Yeah.
Totally.
Again, I'm really interested in the link between monetary policy, environment changes, and the effects on the banking sector in general. We saw that at the early part of the pandemic, there was a massive quantitative easing, a loosening of credit from the Federal Reserve, and that along with changes that occurred in various stages of the pandemic at the very early, let's say, late 2020 to mid 2021, there was actually a tech boom, if you will. Not too long ago, we had technology companies doing really well. And that included also the clientele base of the Silicon Valley Bank. They were also awash with had a lot of cash, and they put part of their deposits into Silicon Valley Bank. But when the Fed started raising interest rate sensitive aspects of the economy, including the tech sector and more risky ventures in general, started to lose some value. And with that, the cash needs of the companies that park their money with deposits at the Silicon Valley Bank also slowly trickle down. So although the deposit withdrawals for Silicon Valley Bank most of it, and the speed with which it increased, the velocity, if you will, really increased in around the first 2 weeks of March. But actually, that process of slowly burning out their cash, using cash to pay for companies' working capital and whatnot, had been taking place at a much earlier rate, and also other similar banks too.
So with that said, one question also came up was, do we know why so many Silicon Valley Bank customers started withdrawing initially? Because there's a lot of stories out there about it started on Twitter or it started in somewhere, and then it was just this quick look and then bang, we're going to pull all our money out. Have you seen anything? Because I've seen a real mixed bag of stories, but I'd be curious to hear what you've seen.
Okay, again, this is my observation as well, Rob, but here's what I think happened. So Silicon Valley Bank had the need several times to liquidate some of their assets in order to meet liquidity needs, in order to meet deposit withdrawals. So the problems had been sort of building up, but the trigger of what happened is that on Wednesday, March 8th, Silicon Valley Bank announced that it needed to raise more than $2 billion from its equity holders. And prior to that, not too long ago, they had taken a $1.8 billion loss on a sale of their assets that were needed to meet that demand. So all of a sudden, this event of them announcing that they need to raise more money motivated certain key influencers in the venture capital world to say that, hey, this is a sign to me that the health of this bank, the solvency of this bank is coming into question. And some did put it out in an official recommendation that we recommend that anyone who has Silicon Valley Bank in their portfolio liquidate out of it. And the extent to which that part I think is pretty solid, the extent to which that announcement from certain key influencers, which of course were announced on social media, the extent to which that traveled more to the so quote unquote rumor mill of CEOs of startups, CEOs of companies, or even depositors, regular household depositors perhaps, that held their deposits there, then that fueled sort of the velocity with which this happened. I think in one day, there was already like 42 billion of deposits that were liquidated. And as just as a bit of a, to give a little bit of a background, Silicon Valley's total deposits was around 175 billion before, if I'm not mistaken, certainly within that range, 175 to 200 at the time that it collapsed.
Totally.
And that's my understanding of it, Rob. Are you hearing, or did you hear of something that
no,
was?
You nailed it. I mean, that's basically, I've heard a mix of stories that what you just said is kind of the prevailing wisdom. Totally. So I'm gonna move on to a related question just a second. I wanted to take care of a very simple question that came up, but it is a good clarification question, is that there's a difference between credit and interest rate risk. And just in case you don't know, credit risk is the risk that a lender takes when it provides credit in terms of maybe it's a higher risk loan than one that's like, let's say, in government securities that we consider to be basically asset risk free. That's credit risk. Interest rate risk is how you balance the revenues you generate from your loans and the interest rates they pay versus what you're paying as a cost of funds. And when those two flip on each other, it causes what's called a yield curve inversion, or that portion of the yield curve can be problematic because the difference between lending rates and deposit costs are, in kind of a hand wavy way, the core profitability of a lender. Thank you for that question. So a question that's related to what we just talked about is now kind of the tail effect. So since Silicon Valley Bank was more of a commercial bank, are there knockoff or knock-on effects, or let's say down the road tail effects on consumer banks? And are there other banks with better liquidity strength otherwise? Do you think that there'll be some residual effects down the road? And then that kind of will lead into our last question when we get there in a couple of minutes.
Sure. Thanks, Rob. Of course. Okay. Let me first preface it with the following, which is when it comes to matters of finance, nothing is 100% certain. So this is my best guess, my best estimate of what is happening. So I think the policy measures that were taken by the Federal Reserve, the FDIC, and Treasury Secretary on that weekend where after Silicon Valley collapse, in perspective, did a lot to calm situations down, did a lot to prevent the failure of 3 banks to become a systemic event. But it did cost it did have a cost, which is they invoked a systemic risk exception. They decided to guarantee all of the deposits in the amount of even in the amount that's greater than $250,000. So even though the equity is wiped out and the Silicon Valley Bank directors are actually no longer in place, the depositors were made whole. But in addition, another important policy move that was made at the time was that the Fed opened up even more emergency liquidity facilities to all banks. That is, they opened up what is called a bank term funding facility to help those banks that might have a liquidity problem, to help them from becoming insolvent, to quash the fears of a bank run on their deposits. That facility allowed banks with a portfolio or ownership of government securities to borrow money from the Federal Reserve discount lending type facility and use those bonds as collateral valued at par. I think that's the key word there. Those collateral is valued at par, and then they could borrow the money in rather short term. That, in my view, did a lot to calm things down, although in the first 2 weeks after that event, we still did see some market jitters. We still did see a lot of depositors at mid-sized banks in general pull their money out of there and then put it into more established banks. And that facility was used quite extensively in that first week. So a lot of regional banks did borrow from that for a week. And I think it was to the tune of 300 billion, if I'm not mistaken. But this week, in the weeks after, that discount window bank term funding facility has fallen quite substantially. So I think that's a sign to be more optimistic about this happening. In terms of broader effect for the economy, is this a systemic event from, let's say, what we saw in 2008, where a banking crisis led to a recession? I also, again, with the caveat that everything in finance and economics is always uncertain, but I think there's a low probability of that because the channel that happened, the so-called financial accelerator channel, perhaps is not as strong this time. In 2008, with the bank failures, that led to a lot of highly indebted households and corporations to then also draw down the value of their own debt and decrease spending dramatically. And this time around, there wasn't so much of that debt-led consumption that ballooned and had to pull back. So perhaps there won't be as much that we see a curtailment of spending that's going to be directly related to this banking problems.
Hopefully. Totally. No, yeah, totally. Hopefully. Yeah. So in the last few minutes, I want to do some related questions to that and then end with kind of maybe the big one out there. The first one is why didn't Silicon Valley Bank think about changing the risk characteristics along the way? Is there, in your mind, is there something that they could have done earlier or should have done earlier? And why did that not happen?
That's a tough one to answer, Rob, but I'm going to try it anyway. So one guess would be that there was the management poorly understand those risks. There's some reporting to that effect. Certainly, they didn't quite understand that high interest rates would have this effect on their balance sheet. Again, these are based on reports. Second one is, well, the US economy environment has gone through several different ends in the last 3 years. We had a recession in the first quarter of 2020, and then sort of a buildup, and then we had inflation coming up really quickly from end of 2021 till 2022. But a lot of people were expecting or putting a high probability by around the end of 2022 that the US economy will be in a recession in the third or fourth quarter of 2023. This was a majority of economists that are regularly surveyed about the likelihood of the recession. Many of them attached a high probability of a recession happening in the latter part of 2023, and they made that prediction in 2022. So therefore, a second hypothesis that I'm willing to investigate further is well, the people who were managing the risk, who were managing the bank, may have been thinking that, oh, interest rates are going to fall back anyway next year, so let's just not change anything. This is certainly an experience that I have seen elsewhere in the 2008 financial crisis too. People said a lot of banks still held down to their mortgage-backed securities, even though they had become underwater, if you will.
So in our last 2 minutes, we got two questions. The first one is, are banks too big to fail? And is this another sign of that?
there have been regulatory measures in place to try to prevent banks from being too big to fail. So since 2008, there is a Dodd-Frank Consumer Protection Financial Act that definitely put much more stronger risk and stress testing requirements for banks. I mean, they really basically call them globally systemically important banks, and they identify which banks those are, and they're subject to more stress testing. So I think, yes, there is always a possibility that banks are too big to fail, but regulations are being put in place to prevent that from happening. So to prevent the likelihood of moral hazard. So therefore, I think we should always try to make sure those regulations are applied.
Agreed. And it was one of the things in the last crisis, I really thought a couple of larger banks probably should have failed just to send a signal that that can happen. And the FDIC orchestrate some change in such a way that would ultimately lead to the Dodd-Frank Act. But it would have been intriguing to see if they would have let some of those market forces play out. The last question we have is one that kind of wraps up a few things you and I had talked about earlier, and it's this. Are bank failures like the one that happened with Silicon Valley Bank actually necessary as far as what the Federal Reserve is trying to do with inflation? And is it actually possible that this will accelerate that change in terms of what's happening? Because I know locally, most of the action that's happened with the wine industry has been more cost of moving accounts, the uncertainty of where lending may come from. But I don't think the short or medium term effects are going to be that big of a deal in terms of what happens here regionally in the North Bay, specifically with the wine industry. I think that you might see wineries a little bit more reticent depending on who their lender may be. But I think the medium term effects will be okay. We won't have a lot of residual. But is this something that from a macro standpoint will actually accelerate the movement down because it will compress credit and spending more quickly?
I think that is certainly a probability that is factored into the Federal Reserve calculation. So if you will, the potential tightening of credit standards and tightening of credit that's coming that may be coming up is going to perhaps make inflationary pressures from the demand side, from the credit spending demand side, become a little bit lower. And perhaps if that is successful, and it depends on the sensitivity, the elasticity, if you will, of the bank's lending to that interest rate increase, or the elasticity of the loan tightening to actual spending in the economy, then that might actually make future jobs more of the Fed to maintain an interest rate level that is high enough to curtail inflation, but not kill the economy, if you will, to minimize the cost of disinflation, if you will. I totally agree with you there. Yeah. Yeah.
I mean, it'll be intriguing to watch and see how credit truly contracts as a result of this. Well, maybe we got time real quick for one more. Will there be an increase in the FDIC limit as a result of this, the 250,000 per account, per entity, per bank?
Right. That's a good question. And I would watch out for an internal review that the Federal Reserve and the FDIC are both conducting. They announced that they will be doing an internal review of their own policies and their own regulatory actions, and announced it by May 1st. Certainly a higher deposit coverage is on the agenda, one of the things they may discuss, but it's definitely not an easy topic to talk about, because markets are very jittery. They were like, are they guaranteed or they're not guaranteed? How do we react? But I think certainly a lot of financial institutions and households and corporations maybe now are thinking about, how do we manage our deposit money? How do we manage the account that we need to have always for working capital, operational expenses, in perhaps several different accounts, spread them out over different banks, different accounts? That may be something of an interesting shakeup that I'd be interested in seeing. And I've also discussed it with one of our colleagues here, Amri, about that. Some interesting models are coming up. Yeah.
No, absolutely. And I think that's the thing to end on, is that at all times like these, if you look at banking history, we've seen some interesting times come on the wake or in the wake of these changes. So it'll be intriguing to see how our regulators, the Federal Reserve, and our macroeconomy all adjust to these changes. So Puspa, thank you so much for your expertise and your time today. And folks, thank you all for coming today. I hope this was informative. I'm sorry if we didn't get to everybody's questions, but I know we're now basically at time and we want to be respectful of your time today. So have a great weekend, and thank you so much. And look for more of these in the future as things come up, or we feel like that there's some expertise that our professors can provide to you all here in the North Bay and beyond. Thank you.
Thank you, Rob. Thank you, everyone. Have a good rest of your day. Bye-bye.
Bye-bye.